the FHFA conforming loan limits are increased to $766,550 in 2024. This, of course, is coming from the Federal Housing Finance Agency. The baseline conforming loan limit for mortgages backed by Fannie Mae and Freddie Mac in 2024 will be $766,550,000, up 5.5% compared to the current limit of $726,200. So this is great news, and to me, right away, my eye goes ding, ding, ding. They are either catching up with home prices, or they are forecasting that they see prices going up even more.
Yeah, and Andy, something like this is really good and interesting for us to see, right? This wasn't started, these conforming loan limits prior to 2008 just were non-existent. Back in the day when I started in the industry back in 2006, when a veteran wanted to come, I want to say the county loan limit was like 417.
It's 417, yeah.
But your medium sale of a home was like 600 and change. So for VA, what that actually meant is they had to put a down payment on that difference.
Yeah, 25% of the difference. Yeah.
But at that point in time, they had what's called an 80-20 or an 80-10-10. What that is in order to avoid mortgage insurance, they do it first at 80% of loan to value of your loan. And then they do either a 10% second and then another second. Oh, wow. But the most common one was a 20% piggyback.
80-20, yeah.
80-20 loan. And, that's the way you would avoid the mortgage insurance. And people had to do that. When you presented like a VA loan, people would be like, nope, we're not going to take that.
Right.
That was kind of looked upon like it's going to be too complicated, so we don't want you to go over there.
Oh, wow.
Where nowadays...
Take the VA.
It was not even close.
Absolutely.
Yeah.
But it wasn't able to catch up, And so, again, you were barely born at that time, Brian.
Was it like 2008?
But it was just pretty crazy. So I'm glad that, in 2008, finally, we had the Housing and Economic Recovery Act that said, hey, we got to start implementing this rule to help people catch up with these loan limits so that they're able to have more people purchasing these homes,
And what it does really too is it kind of loosens the purse strings of money that can come into Fannie Mae and Freddie Mac that those mortgage-backed securities can make it into the market. So by having a government securitization, it allows these investment asset managers to dump billions of dollars into this because it's backed by the real estate itself. And so that actually can bring new money in, and new money in the system, or I should say plentiful money in the system, can help keep rates lower. Yeah. Now, the function of rates going lower in 2023 at the same time the loan limits go up creates an affordability opportunity for people who might have been on the sidelines mathematically, not emotionally, not physically. Oh, I can't move here, can't move there. It's actually maybe mathematically they were on the sidelines, and these two things together, I think, are going to open up opportunities for people in 2024.
Yeah, and one simple example would be, the county loan limit was a $726,200, right? So now that that medium sales price here in San Diego went up to like $900, which is pretty crazy. It actually went to $766. So when we talked earlier, if they're given into a conventional loan and they purchased a home at, say, $726, they could expect they're going to get a rate around 6.6%, more or less, right? Government, they're going to get now a 5.75. So now if their loan amount is above that 726, I say 740, now it's going to be at least about 0.5% to 3.25% higher. Because of it. Because now you're not in that conforming where it's advantageous. And that 0.5% and 0.75%, it could be $100-some, and that right there could keep you not being able to afford that.
And for those of you hearing this example that Memo is giving right now, he's talking about high balance loans, and he's talking about jumbo loans, where that's a different bucket of money. That is not money that's Fannie Mae and Freddie Mac. That's money that is a separate purse, if you will. And because there's scarcity in that purse, the rate is typically higher. So the fact that Fannie Mae and Freddie Mac are increasing their conforming loan limit is going to create less expensive money access to people. What's interesting to me, though, and I don't think I knew this actually until I read this article, which was that their conforming loan limit increases based on the formula related to home price data in the third quarter of each year. So that means that they made this decision now in fourth quarter based on third quarter data. So back to my initial point in this segment, which is they're either catching up to where they should be, or they're forecasting where it's going to be quarter 3 versus quarter 3. And so that was interesting to me too, because again, if we are catching up, then that means that there is no deceleration of home price appreciation. It's going to continue appreciating, or it's going to flatten out, right? I mean, what other conclusion could I come to?
Yeah,
and that's exactly what stood out to me. The increase of 5.56%. It just shows that homes are still appreciating despite the market conditions. Even when rates do come down, the prices are still probably going to hold because of the demand. Now that the rates are lower, prices are going to. I mean, monthly mortgage payments are going to be lower, and a lot more people are going to be like, now it's time to buy, and houses hopefully meet the demand.
Yeah, this is totally in line with a lot of the things we've been reading, which is going to create some confusion at the end of the show today because of this Morgan Stanley thing that got sent out that the home prices are going to plummet. And like, wait, what? That doesn't even mathematically make sense. But
everything's in the data.
Yeah.
But yet we have a one unit in San Diego because every state has a county, and based on your county, there's going to actually be a loan limit. For instance, the conforming loan limit nationwide is that 726,200 currently.
Yes.
It's going to go up to that 766,500, that 5%. Now for the county of San Diego, we're actually looking at $1,600,000.
You have a breakdown of number of units, right?
Yeah.
1 through 4. So let's go over that.
So that's pretty cool because that actually means with conventional financing, you're looking at that 5% down, no problem. 2 units, now we're looking at 1.2 million, 557,950. 3 unit, 1.409,650. 4 unit, 1.561, 350.
Wow.
It's just crazy, guys.
Wow.
This is the first time we've seen it break through the million.
Well, for the single, yeah.
For the single.
And you said the 4 unit is $1.4 million?
1.5.
61. And it's still considered conforming. That means it's going to be backed by Fannie and Freddie.
Well, pretty much.
That's
exactly.
crazy.
For your 4 unit. Yeah.
4 unit.
With 5% down, right? Like, this is crazy.
But I think, it's that thing that we talked about, that they're going to put in, these strategies or, help consumers be able to, find more strategies to get creatively inside their properties, right? And I think it works in a perfect way because little do they know that you're able to use that income from those other units and use that as qualifying income if you're smart and you structure the deal correctly.
Yeah,
absolutely.
So talk about that. Explain that in a little more detail. So you're saying that if you want to buy a 4-plex, your income is going to qualify, but you can use the the gross rental income of the other 3 to help with the underwriting.
Correct.
Well, you already explained it.
Basically. No, but for example, like whenever some of our clients were looking for multi-unit properties, some of the properties on the MLS already had a breakdown of what that rental payment was getting. I mean, rental payment was being paid out every month. So you could already utilize that and say, hey, well, the property's already bringing this in. You could use up to 75% of that to qualify for your mortgage payment. As long as you're going to be living in it as a primary residence, then you can get in there, use the income. And if somebody's already living in there, well, great. You're walking into being a tenant. I mean, a landlord.
That's awesome.
Yeah.
I mean, I don't know how you guys feel about this. I'm not on the front lines of sales anymore, but this is exciting to me because I think this is going to actually create some nice opportunities for people to get into the market.
Well, you know, Andy, you mentioned this back in the beginning of the year that we had to pivot and we had to bring some type of programs to make it more affordable and more appeasing for the consumer. And these are the things, as we're seeing. I know JP Morgan Chase said that home prices are going to plummet and all this. Okay. But obviously, you know, I think Fannie, Freddie, and all them have more analysts that can say the data is going to be different. And therefore, now they've increased the affordability.
But what I like about this is at the end of it all, it gives people that opportunity that, hey, I can get into this real estate investment game as well. And it gives them that opportunity to start being able to see what that Bell's building process looks like without having to say like, hey, I need to use all my money. Well, now you don't have to use all your money. All you got to do is 5% of the purchase price.
Yeah.
No. OPM.
This is awesome, guys. I'm really, really excited about this.
Same.
Anyone who's watching this part of the segment or this part of the show or just this clip in general, you're looking to buy in 2024 with the new conforming loan limits, whether it's 1, 2, 3, or 4 units, go ahead and talk to Will or to Brian and get that started right now so you're prepared to buy in the new year.
Or wherever you're at in the nation, you know. This is going, we're getting great traction on our YouTube channel. You know, thank you, everybody. But talk to your lender. Talk to whoever who's around there, and they can guide you through this whole process.
Yeah, good point.